Welcome back. Okay, let's start with a feeling we all know. You're watching the screen and you nail it. It's a perfectly timed options play, a hot stock you caught right at the breakout, or maybe just a lucky crypto run. Whatever it is, it's an absolute rush, right? But once that adrenaline fades, you're left staring at your account balance with a very real, very serious dilemma. What do you actually do with that money? Because leaving it all in the crosshairs for your next high-risk setup, that's a recipe for disaster. So today, in this explainer, we're focusing entirely on exactly how trading funds retirement growth. Because here's the absolute truth of wealth building. A good trade feels great, but a great trade doesn't retire you. A system does. The stakes here are high. Every single year, traders sit on massive gains, only to watch them completely evaporate because they didn't have a system to capture them. We need to build a structural bridge. A bridge that takes the excitement and the high-risk nature of active trading and safely transports those profits over to a fortress of long-term security.
So let's dive into this. To build that sturdy bridge, we're going to follow a 6-part blueprint today. Number 1, winning trades aren't retirement plans. 2, trading capital versus wealth capital. 3, pay the tax man first. 4, max out tax-advantaged accounts. 5, automate and diversify your wealth. And 6, review, rebalance, and repeat.
Starting right off with Section 1, winning trades aren't retirement plans. The biggest hurdle we face right out of the gate is realizing that trading and retirement require completely separate rule books. I mean, think about it. Active trading thrives on speed and conviction. You see the setup, you execute, you trust your gut. But retirement security, that is built on patience and structure. And look, the goal of this explainer is absolutely not to tell you to stop trading. Definitely keep trading. But you have to understand that the exact mindset that makes you a great trader will actively work against you when you're trying to build long-term, compounding wealth. We have to separate the two.
Which brings us to Section 2, trading capital versus wealth capital.
This is our first highly actionable step. If you take away just one thing from today, let it be this. Treating your account as one massive, undifferentiated pool of money is the single biggest mistake active traders make. We need to draw a hard mental line between these two mentalities. On one side, you have your trading capital. This is the money you actively risk, strategically sized so that a bad month or even a bad quarter doesn't wreck your life. On the other side is your wealth capital. These are the profits you've deliberately harvested out of your trading account and moved into long-term diversified holdings. This is the money that actually buys your future freedom. You can never let the two mix without a clear plan.
So how do we actually move money across that bridge? Well, we use a simple rule of thumb. Once your account grows meaningfully beyond your original risk capital, you systematically skim the gains. We're talking about moving 25 to 50% of your net profits each quarter directly into your wealth capital. And listen, this isn't about timing the market. Don't worry about whether the market is up or down on that specific day. It's strictly about risk management. You literally cannot let one asset class or one trading strategy decide your entire retirement outcome.
Moving on to Section 3, pay the tax man first.
Now, before we get too excited about moving all that money around, we need to pump the brakes and address a very immediate threat to this entire system: sudden tax bills. Depending on how long you held a position and what exactly you traded, you might be dealing with short-term capital gains, wash sale rules, or Section 1256 contracts. But protecting yourself is actually incredibly simple. Before you even think about counting a profit as truly yours to invest, you must set aside a tax reserve. A great strategy here is parking 25 to 35% of your net gains into a separate, high-yield savings account that is earmarked strictly for taxes. An unexpected tax bill from aggressive trading can blow up a retirement plan instantly. Seriously, don't let it happen to you. Keep it separated.
Section 4, max out tax-advantaged accounts. Once the tax man is accounted for, we reach the actionable climax of our blueprint. It's time to funnel those harvested profits into sheltered accounts. Because this is where your money does its absolute most powerful, heavy-lifting, long-term work. Let's look at the numbers. For 2026, the IRS actually increased contribution limits, and you can now contribute up to $24,500 into a 401k. That is a massive chunk of trading profits you can shield. And remember, if your employer offers a match on any of this, you take it. That's an immediate, guaranteed return that absolutely no trade setup can reliably beat. And just as a quick side note, if you're 50 or older, your limit jumps. $32,500 is your new 2026 limit for that 401k. The IRS is giving you a larger bucket to shield your wins, so definitely use it.
Finally, we have the IRA limit for 2026, which is $7,500, and that's combined between traditional and Roth. And yes, there's an extra $1,100 catch-up if you're 50 and older. The core strategy here is just building a practical habit. Whenever you harvest those trading profits, funnel a portion straight into whichever tax-advantaged account you haven't maxed out yet. 401k, IRA, Roth IRA, maybe even an HSA. You want to shelter every possible dollar, because every dollar sheltered today compounds so much faster tomorrow.
All right, Section 5. Automate and diversify your wealth.
Now we get to celebrate the totally unglamorous, wildly effective mechanics of wealth building. The irony of all this is that the exciting, heart-pounding trades, they're really just the fuel. It's the beautifully boring, set-it-and-forget-it background systems that actually buy your financial freedom. The more boring it feels, honestly, the better it's working. So, the crucial takeaway here is you must use your trading profits to diversify away from your trading exposure. Traders naturally fall in love with the names and strategies that made them money. Don't fall into the trap of a concentrated retirement account. Protect the wealth you've built by putting it into broad market ETFs, index funds, and bonds that do not move in lockstep with your trading book. Alongside this, keep 3 to 6 months of expenses in a perfectly boring cash equivalent. Why? So a sudden life surprise doesn't force you to liquidate your retirement or blow up a trading position at the absolute worst possible time.
And how do we guarantee all of this actually happens? We automate it. Let's be real, willpower is incredibly unreliable, especially when you're riding the emotional roller coaster of trading. But automated systems, they're flawless. Step 1, set up auto transfers to your retirement accounts on a fixed schedule. Step 2, set up auto increases when your income rises. And Step 3, create a standing, unbreakable rule with your bank to move a fixed percentage of any trading windfall straight into your long-term accounts before you even have a chance to spend it. Seriously, let the machines do the discipline for you.
Which brings us to our final step, Section 6. Review, rebalance, and repeat.
This is the maintenance phase of our system. You've built the bridge, the automated cars are driving the money across, and now we just need to keep the roads paved. And this happens once a year. Not once a week, once a year. But listen closely to this part. Before we jump into the maintenance itself, I have to warn you directly against the overconfidence trap. Success creates a really dangerous psychological pattern. A few wins start to feel like pure skill rather than market variance. If you aren't careful, that emotional high bleeds into your retirement decisions. You'll start chasing concentrated bets in your IRA, or you'll try to time the market with your 401k. Do not let the trading rulebook overwrite your retirement rulebook. Remember, they are completely separate games.
So, let's see how this builds into an annual maintenance routine. Once a year, you pull up a checklist. Look at your trading account, your retirement accounts, your tax reserve, and your emergency fund. You're checking balances, sure, but more importantly, you are rebalancing if one asset class has drifted way too far from your target. You're updating your tax estimates based on your trading volume. You're verifying that boring emergency cash is still there untouched. And you're checking to make sure your automated transfers reflect the new IRS limits, which, as we know, usually rise with inflation. Basically, just keep the system tuned.
We've seen exactly how trading funds retirement growth today. The traders who end up financially secure aren't always the ones with the absolute best win rate. Actually, scratch that, they rarely are. They are the ones who built this repeatable, unglamorous system for converting exciting short-term gains into diversified, tax-advantaged wealth. So I leave you with this to think about as you go back to the charts. Will your next big win actually fuel a long-term plan, or is it just going to be another trade? Trade actively, invest patiently, and build your bridge. Thanks for joining me on this explainer, and I'll catch you on the next one.